Oil surging another week as the conflict in Iran drags on and the Strait of Hormuz closure roils global energy markets. Investors watching the fallout as the Pentagon steps up operations, sending more Marines and warships to the region and low-flying attack jets over the strait. Joining me now is the CEO and CIO of Richard Bernstein Advisors, Richard Bernstein. Rich, great to see you again. And congratulations, by the way, on the sale of your firm to Janus Henderson. I hear they are excited to have you on board.
Yeah, everybody's thrilled. It's a great symbiotic relationship, and everybody's very excited. Thank you.
Sure thing. So you just published a special report about investing in a time of war. You say ignore the politics, but not the impact. Why do you see parallels between now and the 1960s?
Yeah, so Jack, I don't think that many people remember, or probably weren't even alive, during the 1960s. And the 1960s period was characterized as a guns and butter period. What that meant was during the Johnson administration, they wanted to spend on the buildup to the Vietnam War. At the same time they wanted to spend on social programs. They believed they could do both with having no impact on the deficit and no impact on inflation. Well, of course, that turned out to be wrong. Well, today, we're not seeing social spending, but we are seeing substantial tax cuts in 2026. We all know the big, beautiful bill. If it's big and beautiful, it's going to have an impact. At the same time, obviously, that we're building up defense spending for, you know, whether it's Iran or Venezuela or Cuba, whatever you want. And so it's not the same as the 1960s, but there are certainly parallels.
And another phenomenon that's happening now, different from, say, 15 years ago, is this deglobalization. Globalization kept a lid on inflation. Deglobalization has the opposite effect. Can you explain that?
That's right. Jack, this has been one of our main underlying investment themes for the past decade, was that we would argue that the reason that the United States experienced secular disinflation, very, very low rates of inflation, was because of globalization. Because what globalization did was simply increase competition. And I don't think anyone needs a PhD in economics to know when you increase competition, you get downward pressure on prices. Well, in the last decade now, we've been in a process of very gradual deglobalization, which means that you're decreasing competition, which puts upward pressure on prices.
Okay, so the question is, how do you invest in that scenario?
Right. So I think, you know, people have to sort of, in a period of inflation, history says it pays for investors to shorten their time horizons, meaning in the equity market, people should start thinking about dividends instead of long-term growth. They should think about, say, short-term fixed income investments instead of long-term fixed income investments. They probably want to think in terms of commodities and real assets as well. Not that you should swap your entire portfolio, but the data seem to suggest that investors are woefully underweight and underexposed to things like dividends and commodities and things like that.
And you mentioned short duration. So what's the fixed income playbook? I assume, among other things, keeping it short.
Exactly. I think right now, you know, in the backdrop, we have some credit problems popping up as well. So our preference is for shorter term, higher quality fixed income. In our portfolios right now, we're holding things like mortgages and munis and treasuries, but shorter term, not long term, because of those inflation fears that are still out there.
Now, there's, of course, been a lot of expectation, hope for rate cuts. In fact, just this past week, we heard the president saying some unkind words about Mr. Powell, perhaps because he'd like to see more rate cuts. But everything you're saying right now suggests that rate cuts are not in the standard policy response to the phenomenon that you're talking about.
Right. I think if we could remove the politics from the situation, which obviously is very difficult to do, but if we could remove the politics from the situation, I really don't think the Fed would be thinking about cutting rates. And there's a chance that they would actually be talking about raising rates because of these inflationary pressures that they're building in the economy.
Yeah, and we might have seen that start to affect the bond market right now. Rich Bernstein, thank you so much. Appreciate it.
Jack, great to be with you.